Canada's been seeing economic growth, including in more employment, and with the dollar on the rise. Our next guest has just turned bullish on the dollar for a number of reasons. Here to unpack them is David Rosenberg, founder and president of Rosenberg Research and Associates. And David, thank you very much for joining us.
Thanks for inviting me on.
What makes you so bullish about the dollar right now, the Canadian dollar?
Well, look, I'm not a raging bull, but I've been becoming in the past several months increasingly less bearish. We were negative on the Canadian dollar, and for the most part, quite right for the last couple of years. But as John Maynard Keynes said, when the facts begin to change, you should start to change your view. And so there's been some changes at the margin in the past several months that we've taken notice of. One of them being that the Bank of Canada seems very comfortable staying with the policy rate where it is at 2.25%. The Fed just cut. They're probably going to cut some more. I think at least one more rate cut. I think in the U.S., the dot plots, I don't really pay much attention to them. I think the Fed's got at least 2 or 3 more cuts, and the bank's on hold. So the interest rate differentials are going to increasingly be a tailwind as opposed to what was a headwind for the Canadian dollar through much of the Bank of Canada's easing cycle, which of course took place before the Fed started getting into the game. So that's one part of it. The other part of it is that our terms of trade, our export prices relative to import prices, which has a strong correlation with the Loonie, has started to really improve. We got to keep in mind that unlike the United States, Canada, much like New Zealand and Australia, we are a hard asset currency, and the commodity sector is starting to look a lot better, especially in the base metals, and oil prices look to be putting in a floor. So that's added good news. There's certainly less negative news for the Canadian dollar. And then it'll come down to the fact that, we dodged a bullet because, you go back to the spring, we thought that Trump was going to unleash a major trade war against Canada with all those reciprocal tariffs, that we're going to enter into a global trade war, which would have additional negative consequences for Canadian economy because we're a small, open economy. So we dodged those bullets. And the reality when push comes to shove, and this is what's different with Carney vis-a-vis Trudeau, is that whether you like it or not, I certainly don't mind it, is that Donald Trump has chosen to like Mark Carney. You know what that means for renegotiating the trade agreement next year remains to be seen. But the reality is this, that for all the angst and anxiety over the tariff file, when you look on a relative basis to the rest of the world, we came out relatively unscathed. Most of the products that Trump slapped tariffs on, most of them are covered by the trade agreement and weren't affected by the tariff war. So, of course, we're still all upset about the 51st state and, a lot of the stuff that Trump has said in the past. But the reality is that when you look around the world, we came out actually a relative winner from the Trump tariff file. So all these things put together, and of course, we look at valuation metrics. We look at valuation of the stock market, and in the U.S., it's nosebleed levels. But for the Canadian dollar, the valuation metrics that we looked at in the past couple of months were telling us that the Canadian dollar was extremely undervalued. The question is, what was going to be the spark? And I'll tell you that it's not just the Fed still cutting rates and the Bank of Canada on hold, but I gave the Carney budget a B minus, which sounds like I'm a tough grader, but I haven't given a mark like that for a Canadian federal budget since the Harper years.
Wow.
So there was lots in there because it really was at its root. I mean, look, every budget's going to have its warts, its pimples, and its scars. But I did like the supply side productivity nature to this particular budget. And the fact that now we're starting to see Mark Carney, I'm sure the environmentalists are all up in arms about it, but I'm here forecasting the Canadian dollar. The fact that Carney at the margin has shifted away from his, green thumb pro-environment policies towards something that's more pro-growth, especially on the resource side. To me, if you're a Canadian dollar watcher, that's another big positive. The fact that we have a more responsible immigration policy now means that, and as you said about the economy, we're finally starting to see for the first time in many, many years, positive growth in real per capita terms in Canada. So absolute terms growth might not be that great, but per capita it's been negative because of our unprecedented immigration policy. So that again, at the margin, all this stuff helps. 77-cent dollars. Like, I'm not saying we're going back to par. Wouldn't it be nice if we ever did? But I think that enough of the negatives, enough of the headwinds have been taken out to at least shift from what was the long-term bearish stance on the loonie to something that's a little more moderately positive.
And what might be some of the challenges with a 77-cent loonie? Those are, you mentioned the positives, or what will guide it and what will bring it up to there. What might be some of the challenges as the dollar rises, though?
I don't think that there's, so long as the Canadian dollar doesn't go above its fundamental valuation metrics, there's nothing wrong with it. It's not like, the Canadian dollar is going up and this is going to be a major impediment to the manufacturing sector. It's basically just the Canadian dollar is a price, like everything else is a price. It's a price, and the price is revealing some of the improving fundamentals in the Canadian economy. So it's not like you're going to say, oh, well, the Canadian dollar is appreciating, we should all be worried about it. We should actually embrace it, because when you really think about what is a currency, what's an exchange rate, it's a relative pair trade. So here we're taking a look at Canada versus the US. We could look at Canada versus other countries. But when your currency is appreciating relative to your neighbor, it means that relative to your neighbor, things are going right on a relative basis. So I think it's something that we should be embracing, because it's a price that reflecting at least something that isn't as negative as it was 6, 12, 24, 36 months ago.
And what does that do for servicing debt?
What does it do for servicing debt?
The stronger.
Okay, well, that's a real circuitous argument. That it doesn't do anything for servicing the debt, except insofar as if I had to basically, draw an argument, really second round impact. It's basically a stronger dollar will help contain import costs. It is ipso facto something that would be inherently disinflationary. So it would mean the potential that interest rates can come down at the margin. But that's drawing a really indirect link. But if you're talking about how to service the debts, because a stronger currency leads to lower inflation as a standalone event, it should be good news from that perspective, at least at the margin.
Okay, David, we're going to have to leave it there, but thank you very much for joining us.
Pleasure. Take care.
David Rosenberg is founder and president of Rosenberg Research and Associates.